It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Apparently, Israel has attacked Iran. I know there's a lot of strong feelings on both sides of the issue. That's not my focus for the moment. My focus is going to be what now? How does that affect us, affect our economy, our money, those types of things? The most obvious thing that likely will happen is oil prices will rise, potentially substantially. Some projections, I believe by JP Morgan state, oil prices could as much as double from where they are now, particularly if this new Middle Eastern war lasts for a period of time. Certainly we should pray for peace or a quick ending to this. That's my hope and prayer. Previous Middle Eastern wars have happened very quickly, but unfortunately, I don't know that that's going to happen this time. Iran truly has a military. It's been reported they have upwards of 2,000 ballistic missiles. They've been preparing for this type of encounter for quite some time. Iran is a substantial country with a substantial military. I have no idea how this is going to play out. Unfortunately, it has a good potential of not being resolved quickly. From a human suffering standpoint, that's the worst case scenario. Also, from an economic standpoint, the same. Oil prices increasing significantly are one of the few things that can cause our country to go into a recession all by itself. That could have significant impacts to the stock markets, asset values. My point is quite simple. No one really knows what's going to happen. Hoping for the best is the best course of action, but you certainly should plan for the worst, particularly when it comes to your money. My best advice is protect yourself, reduce your market risk. If you are exposed, I would strongly recommend reducing that exposure. A war between Israel and Iran could drag out for quite some time, potentially could be quite horrific. And from an economic standpoint, about 20% of the world's oil goes through that region. So it would have a significant impact on energy prices, which can cause inflation and recession all by itself. So be careful. Keep a close eye on this. Now, there is some good news on the economic front. Apparently, a deal has been struck with China regarding tariffs. If indeed this is approved and settled, this would be great news economically and would remove a great deal of uncertainty regarding the tariff policies that have been going on. Much of the volatility of the stock market over the last couple of 3 months has been due to the uncertainty regarding tariffs, and China is the big player. There's just no two ways about it. According to a message sent out by President Trump, goods entering into the United States would be tariffed at 55%, and stuff we send to China would be taxed at 10%. Also, the rare earth minerals that are needed would be supplied by China. This is all good news, again, from an economic standpoint. Also, overall, an increase in tariff revenue will likely come about as a result of this because the tariffs would be a little bit higher than they were before, but not a significant amount that it could cause some real economic devastation to our economy. Now, some of the unanswered questions are, will U.S. companies have access to the Chinese market? That wasn't addressed here. That's been a major point of contention. If companies could market products into China, that could be a huge benefit for many U.S. companies. The Federal Reserve for the past several months has been in a holding pattern, much of it because of the uncertainty with the tariff policies. So again, if this is an agreement is signed with China, that would eliminate much of the uncertainty. Inflation is certainly on the decline. It's still slightly above the target. The latest numbers came in at about 2.4% annualized, which is just slightly above the target of the Federal Reserve of 2%. So if the Chinese tariff situation again is resolved and inflation approaches that 2% mark, we could potentially see a rate cut with the Federal Reserve. Please understand though, if you look through historical averages, the interest rates are just slightly above average. So it's not that it's a significantly high level per se, it's just significantly higher than it was over most of the past decade, largely because the Federal Reserve kept interest rates at historically low levels for so long. We got used to that. Will the Fed return to those types of really historically low levels? I don't believe they will, and there's a number of reasons behind that. One of the most important is the bond market, which I'll discuss here in a few minutes. Another key thing that's occurred recently is over the past month or so, the S&P 500 has increased by like 20%, which is the third best run for the history of the S&P 500 this century. Also, the NASDAQ has risen 27%, which its third largest rally since 2002. In fact, only 2020 and 2008 have seen sharp recoveries greater than this. This puts the S&P and the NASDAQ 100 back to near all-time highs. It's ironic that we've gone through from a historically weak market over the couple of months ago to now a historically strong market. Will this Middle East war between Israel and Iran disrupt all that? That remains to be seen. Certainly when you're at extreme highs or near all-time highs, the risk is elevated. So again, something to be aware of, pay attention to, proceed with caution. A couple other key points about the markets. There's a chart of leading economic indicators. And if you look at this chart since 1970, the combination of the leading economic indicators and the stock market correlate pretty well. It's rare that they diverge much from each other. Yet, since 2021, we are seeing a historic divergence of the chart of leading economic indicators and the S&P 500. In fact, the leading economic indicators peaked in 2021 and have been sliding down ever since, yet the S&P 500, for the most part, has been just surging forward. This divergence is not a good sign for the future of the stock market. And if you dive into it a little bit further, and you compare the S&P 500 to the Russell 2000, which is made up primarily of small cap stocks, they're down 13% since the 2021 peak. In other words, this run up since 2021, the past 3 years or 3 to 4 years, in the S&P 500 has left the small caps behind. It's a concentrated run up of more of the large cap stocks. This is further confirmed by GDP of small businesses. You see, small business makes up about 43% of the U.S. GDP, and they provide about half of all jobs. It's often been called the backbone of the economy or the backbone of America. By every measure, it's struggling. Small business, small caps are struggling and have done so for the past 3 to 4 years. They haven't completely broken down, but they're certainly struggling. And lastly, something to pay attention or be concerned about is stocks haven't been this expensive relative to bonds in nearly 25 years. I've often shared on this show, this is the golden era of fixed assets. Bond yields or interest that bonds are paying are at some of the highest levels we've seen in decades. At the same time, the stock market is at or near all-time highs and is in the upper 90th percentile in terms of historical price to earnings ratios. So in other words, stocks are historically expensive while bonds are offering historical high interest rates. This is attractive to many people, many institutional investors in particular. And I'm going to share some of the reasons behind that in this next segment. So I'm going to encourage you to stay tuned.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to contact me, you can do so at yourpersonalbank.com. Yes, you will reach me. That's yourpersonalbank.com. A report came out recently from Pimco. They're a well-known bond investor giant in Wall Street. And as they stated in their report, stocks haven't looked this expensive relative to bonds since the end of the Clinton administration nearly 25 years ago. Yet, as they point out, bonds look better than they have for a long time. And that's one of the key takeaways from this report. And I quote, "In short, the traditional world order in which economics shape politics has been turned on its head. Politics is now driving economics, especially in the U.S., and increasingly in how other countries respond. A perfect example we can use is the tariff policy uncertainty we've seen over the last few months, and now potentially another Middle Eastern war between Israel and Iran. If that continues over an extended period of time, that's certainly going to have impact in oil prices and will impact the stock market significantly. We also have, as the Pimco report refers to, is extreme levels of government debt, both in the United States and other countries worldwide. The fact that this is the golden era of fixed assets creates an opportunity for the individual investor. See, most people don't have the wherewithal or knowledge or desire even to be investing in a bond auction or the bond market directly. You typically need a significant amount of assets to truly be involved. So one of the ways you can take advantage of that is invest in companies that do invest heavily in bonds, which happen to be insurance companies. They also provide guarantees, tax-free growth, access to your money, high liquidity. They provide extra benefits, plus they tend to pay a higher dividend than bonds pay because they have other income sources, revenue streams, so they can pay you more than you would receive if you strictly purchased a bond. So as Pimco pointed out, economic shaping politics has been turned on its head. It's now the opposite, and that's one of the reasons in the show I discuss politics, current policies, the impacts of those, because even Pimco themselves has stated politics now drives economics. This is something I've seen now for several years. It's just becoming more and more pronounced. I had a discussion recently with a listener who's a very experienced investor. And one of the questions he was asking is why somebody would invest in bonds when they can receive a potentially higher return in the stock market. My response to him was he had to understand the difference between the typical retail investor and the typical institutional investor. And what do I mean by that? Well, if you take a large institutional investor like a sovereign wealth fund, pension fund even, a bank or an insurance company, oftentimes they have obligations, like a pension fund has pension obligations. A bank has to pay out a certain percentage on CDs. Insurance companies pay out dividends. And they have target rates that they want to hit or obligations that a pension fund needs to meet. And a certain portion of their portfolio is often set in advance to purchase in the bond market. Banks, for example, have to have 25% of their assets in Tier 1 capital, which defined by the FDIC is cash, cash equivalents, or cash value in life insurance policies. Well, if you have cash, you're earning no interest. If you're a bank and you invest in cash equivalents, that'd be like savings and money markets. You might be able to get 3 or 4% today. If you invest in cash value life insurance, you're probably getting 6% or more. Well, where are you going to put your money if you're a bank? It's required regulatory-wise to have a significant portion of their portfolio there. You might as well invest in the asset that's going to pay you the higher return. Insurance companies are also highly regulated and oftentimes have upwards of 80% of their portfolios invested in bonds. Pension funds have similar types of regulatory requirements and targets. So if you take a pension fund or an insurance company or a bank who has these obligations to pay out this certain interest rate on the investments they're offering, And if they can get a 5% return, for example, on a 30-year treasury, and that return satisfies their obligations for that portion of their portfolio, well, they just locked in or risk off. They eliminated the risk on that investment for the next 30 years, haven't they? In other words, the typical average retail investor, is Wall Street defines that loosely as someone with 10 million or less in liquid assets, is typically more focused on maximizing returns, while the typical institutional investors is looking at minimizing risk. In other words, they discuss risk off. If it's an insurance company and a 5% return on half of their portfolio satisfies their obligations, or again, a bank or a pension fund or whatever, and they can lock that in for the next 20 or 30 years, they're going to take that in a heartbeat. Now, why is this so important to understand? Well, on average, about 88% of the stock market is owned by institutional investors. The other 12% is owned by the average Americans or retail investors. Which side moves the market, the 88% or the 12%? Well, that answer is quite obvious. So in general, should you be paying attention to the 12%, the retail investors, the average American who's investing in the stock market, what they're doing or not doing? Or should you be paying attention more to what the 88% are doing and thinking? Again, when you understand that, the answer becomes obvious. In that understanding creates opportunities. Once you understand that a higher yield in the bond market, although may not be an opportunity for you or one that you would want to pursue even, if you could, knowing that much of the institutional money is now shifting their focus or shifting their investment strategies to the bond market, which means they're leaving the stock market, what's that going to do to overall asset prices? As I stated earlier, we all know if oil prices surge due to a Middle Eastern war, for example, that's going to have instant pressures on economic growth, on the stock market, on inflation, those types of things. We see those immediately. But a more slow-moving and longer impacting situation is when bond yields offer an attractive return, much like Pimco is stating. And why are they doing that? We've discussed this on the show so many times, but it has to do mostly with the levels of government debt. And in fact, it's not just the United States. I have focused on the U.S. debt a lot. There's a level of concern about the U.S. debt that needs to be genuinely addressed. But at the same time, I don't want to over portray it as too much of a crisis because we're not there yet. And what I mean by this is really quite simple. If we take some of the most recent numbers, this is data that's available through April of 2025. And understand the U.S. government runs on a fiscal year, not the calendar year, in terms of their budget. So if we take the numbers from April of 2025, we're looking at the first 7 months of the most recent fiscal year for the U.S. government spending. So the last 3 months of 2024, the first 4 months of 2025. In that time frame, the government has received about $3 trillion of revenues or income. At the same time, they've spent just over $4 trillion in expenses, which means they're underwater or spent about $1 trillion more than they received. Again, that's through the first 7 months of this fiscal year. A different way to break this down, and this I think you'll find very important, is the deficit or the excess spending is about 34% of total receipts. Think of it this way, a debt to income ratio. Anyone who's ever purchased a home with a mortgage has dealt with this and understands when you qualify for that mortgage, a rule of thumb with traditional mortgage lending is you don't want to have more than 30% debt to income ratio. Or in other words, if you earn $100,000 income, you don't want your mortgage payments to be more than $30,000 a year or 30% of your total income. That's your debt to income ratio. You typically are not approved for a mortgage, certainly not a traditional one, if your debt is higher than that. The reasons behind that are quite simple. If the debt it gets too high based on the amount of income you earn, it's hard to sustain that level of debt. Currently, the U.S. government is running a little higher than that at 34% debt to income ratio. Can our government handle that level of debt? Generally speaking, yes. As you add on to that each year, which has been building up for about the last 20 years, frankly, much of this spending, excess spending, really started ramping up after the 08-09 financial crisis, and it's been continuing to increase ever since. So this isn't political. This isn't one party or the other. Both are at fault. The spending just continues in general to increase. It builds upon itself. Once you get past 34% debt to income ratio, it starts becoming difficult to maintain your finances. Now, granted, the U.S. government has some additional mechanisms to help offset that where an individual or business doesn't. They can print money, which creates more inflation. There's some other accounting things they can do to help offset that to some degree. So they do have some more leeway than an individual family has, or household or business, but there are limits to that too. Moody's, who recently downgraded the U.S. credit, pointed out that in the next 5 to 10 years, their projections were the level of debt, if continued, would become unsustainable, or it is at unsustainable levels now, but would then become a crisis. I kind of agree with their analysis on that. We probably have about 5 to 10 years to fix the problem or start alleviating it. Even if we don't totally fix the problem, but we cut excess spending in half, for example, it would at least buy us some more time before we hit crisis levels. Should we be concerned about this? Absolutely. Is it a crisis yet? No, but we're definitely heading there. I'm going to encourage you to stay tuned. Next segment, I'm going to share some more thoughts about this and then how to navigate this and thrive through this higher for longer interest rate environment that we're likely going to see for the next 5 to 10 years.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferens Toth. Want more information? Contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferens Toth.
Welcome back to the Your Personal Bank Show. This is Ferens. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I'm referring back to this discussion I had with this very experienced investor, and he was sharing some concerns about the currency, the value of the dollar, all these types of things we hear about. And again, I'm not saying there is not reason to be concerned. There is. We are at unsustainable levels with the debt. Any reasonable person can argue that point. Are we at crisis levels? No. Is it bad? Yes. Are we crisis levels yet? No. Best estimates, again, this is from Moody's and other sources, we probably have around 5 to 10 years or so before we hit crisis levels where austerity measures, various things like that may happen. But here's another reason why I'm not in complete crisis or doomsday mode, and why shifting to safety is probably a wise move. It's made easier now because it's the golden era of fixed assets, so you can get tremendous returns on annuities, cash value, life insurance, guaranteed income riders, products like that we haven't seen in 40 plus years. So you can get returns that will likely rival, if not outperform, the S&P 500 for the next 5 to 10 years. And that's not me saying that. That's JP Morgan, BlackRock, Vanguard. Their analysts are all echoing the same sentiment. The main reason behind this, regardless of the tariff situation, Middle Eastern wars, or anything else, it's the debt. And it's not just U.S. debt, it's worldwide debt. Golden sovereign debt issuances have hit a record $18 trillion worldwide in 2024. World governments are issuing more debt than ever. You see, the problem is governments bought into this school of thought called modern monetary theory. On the surface, it sounds good, but there's a real problem behind this. What modern monetary theory states is that a country never had to default on debt because it could just simply print more money to meet its obligations. Now, while this might be true in theory, it's really not practical in practice. The reason behind it is really quite simple. As a country continues to issue more debt, print more dollars, they create more inflation, eventually becomes economically unsustainable. As you issue currency, you have to have somebody buy the bonds to offset the currency, whether it's the US or some other country. Well, we've seen this happen even in fairly recent times. About 15 years ago, Greece, their debt became so untenable that bond buyers just refused to purchase the bonds anymore. This forced them into what's called austerity measures. And I find it's funny, austerity measures is really just nothing more than, it sounds like some terrible thing. It's actually a very common sense thing. Only in Washington is common sense considered radical. See, austerity measures mean nothing more than the government now then lives within its means. In other words, it spends what it receives. What a novel concept. By the way, that's a concept you've lived with your entire life. Your household budget, your business budget, has operated under austerity measures for most, if not your entire life. Yes, there may have been a period of time when you took on some debt. Maybe you spent more than you received for a period of time, but eventually that runs out because you can only borrow so much. Eventually you either bankrupt it or pay it back, right? That's your two options. The point I'm trying to make here is, yes, moving from a modern monetary theory policy of printing unlimited amount of debt to living within your means, that transition would be chaotic. If our federal government did that today, all government spending would drop by about 30% across the board. We're talking everything, military, Social Security, you name it. Would that be economically devastating in the short run? Absolutely. That transition would be massive. But in the long run, it would actually work out for the better. If anybody's gone through financial challenges where they had to make dramatic changes in their spending because of too much debt, or even went through a bankruptcy, they've experienced that type of thing. Is it traumatic? Is it chaotic? Is it challenging? Absolutely. Is it fun? No, not at all. Was it good for you in the long run financially? Yes. You see my point. Wouldn't it be amazing if a country got serious about financial responsibility and instead of carrying so much debt, limited that debt? They would stand out from the rest and be one of the strongest economies in the world as a result. This is something we could strive for, and I believe could be achievable over time if people would just use some financial responsibility, much like they do in their own personal households or business. Just because it's a government doesn't mean it needs to just spend money like a drunken sailor. The key point people need to understand is that governments have no money. None. Where do they get it from? From taxpayers. Or they print more. So either it's our money they're spending, we should demand that they be financially responsible, and if they're not, we have an option in this country. We can vote them out and replace them with somebody who will be, or printing additional money creates inflation, which means everyone pays more for everything. It's because of this historic levels of debt, sovereign debt, bonds that have been issued by countries all over the world, is why the World Bank came out with a report recently sounding the alarm that the global economy is set for the worst decade since the 1960s. They refer to a number of reasons behind this, but the primary one is the level of debt that most of these countries are carrying will be a drag on their economies. Well, if you have slower economic growth, you have lower earnings with companies, don't you? When you have lower earnings with companies, what do stock prices do? They may still go up, but certainly not as much, or more tepid growth, or even lose value. This is one of the primary reasons why JP Morgan, BlackRock, Vanguard analysts have all come out and stated why fixed assets, like dividends with insurance companies, annuity returns, are likely to outperform the S&P 500 overall over the next 5 to 10 years. Tepid growth, if any growth, in the stock markets because of lowered earnings expectations, etc. While at the same time you have record levels of debt, record levels of bonds being issued, which means these governments have to offer higher interest rates to entice these bond buyers to buy them, which pushes interest rates up overall, bond yields, dividends with insurance companies, annuity returns, seems some of the best returns in over 40 years. It ain't going away anytime soon, folks. If we take the U.S. alone, just for example, we're approaching $37 trillion in debt. Even if the Trump administration and Doge and all these things that are occurring succeed at their most optimistic levels, let's assume they eliminate the deficit. Let's assume they get spending under control, eliminate fraud and waste. And I'm all for all those things. But let's take the most optimistic projections, even by those organizations. Does nothing to pay down the existing 36 trillion plus of debt that's on the books. Their goal is for our economy to continue to grow, increase GDP, which means the debt to income ratio that I was sharing earlier would be lower. If we have more and more income, then the amount of debt, if we stop building upon it, if our government stops spending more than it receives, the amount of debt will not increase anymore, other than the interest on it. If we can outgrow the interest on the debt, we could potentially grow our way out of it. But frankly, that's becoming a bigger, more and more difficult scenario, because the average interest rate that the federal government is paying on bonds right now is around 3%. As their bonds continue to mature and they have to resell those bonds, this is the outstanding debt that's on the books. As they resell these, they have to sell them at the current interest rate, which is much higher than it was for much of the last decade, which means the overall interest rate on bonds that the federal government is going to be paying will increase. Let's say it increases from the average right now of about 3% to about 4%. Remember, the government sells bonds all time frames from 4 weeks to 30 years and everything in between. Let's say the overall average that they're paying out is 4%. That means a 4% increase of GDP would mean we'd be marking time. The amount of debt to GDP, the debt to income ratio would stay the same. Again, assuming no additional debt is added on, no additional deficit spending. Well, a 4% GDP growth rate on average is pretty aggressive. This is part of the reason why Trump is pursuing all these business deals, tariff incomes, all these other types of reshoring manufacturing, re-kicking our economy into gear. These are all good things. I'm in favor of all that. But that's a pretty aggressive growth rate. Let's assume we hit 4% growth rate, GDP on average. We're still just marking time. We're still not knocking down the existing debt or the GDP ratio. And future growth is not guaranteed. Certainly it's desired, but there's nothing guaranteed about future growth, is there? It's like you have a job or business and you have income, and there's nothing guaranteed about next year's income, right? Something could happen. The economy takes a turn. You lose your job. Your business, you got new competition. A health issue occurs. Something happens to your income. So again, future income is not guaranteed. It's the same thing with governments. GDP, gross domestic product increases in the future is not guaranteed. Likely, but not guaranteed. Spending cuts, though, are. I'm going to tie this together with a thought I share commonly with people in the next segment that I think will put it together and help you understand better how this debt and excess spending is really impacting us, our economy, and will so long term. And again, the government's lack of fiscal responsibility creates an opportunity. It's a golden era of fixed assets. You can take advantage of that. If you want more information, certainly contact me at yourpersonalbank.com.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to contact me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I've been sharing this thought about GDP, gross domestic product, our income as a country, if you will, our debt. Oftentimes, people kind of gloss over because the numbers, you talk about trillions of dollars, it's incomprehensible the amount of monies that we're talking about. But if you boil it down to, say, a typical household, it starts to make some logical sense. And I've used the example, let's say you're a household earning $100,000 a year income, and you have $125,000 of debt. Approximately $18,000 of your income is going to service of that debt. Can you handle that? The answer is yes. Is it ideal? No. If the interest on that debt suddenly increased fairly significantly, so instead of paying $18,000 a year, now you're paying $25,000 a year of interest, $35,000, you can start to see after you get up over a certain number, it becomes unsustainable. It's the interest on the debt's too much. You can't live on the rest. And that's what our federal government is facing. Most economists, Moody's, for example, are predicting those crisis levels are going to be happening in the next 5 to 10 years. What's going to happen in the meantime? Well, again, the government sells these bonds. As they continue to sell more and more debt, more and more bonds, they have to entice the bond buyers by increasing interest rates, which means fixed assets, returns, dividends on insurance companies, annuity returns will continue to stay strong and increase as this interest rate environment continues to stay on the higher side and likely pushes higher until at some point the bond buyers just balk like they did with Greece and government's forced into austerity measures, which means we'll have some economic chaos short term, certainly. It's not the end of the world. It's not, by the way, we go to austerity measures. It doesn't mean the currency is not going to lose value. In fact, it would increase in value. It's like a start over almost, if you will. If the government stopped spending so much, was forced into austerity measures, suddenly our currency would be worth more because our financial outlook going forward would actually be improved. That's the thing most people don't think about. They're worried about the currency devaluation. Actually, it's going to, if we stop spending so much, it'll actually shift the other way. See, the real problem, again, is the too much spending, the debt. Again, I'm going to bring it down to household level. I often ask this question to people. Let's assume you went to work or your business and you found out you were getting a $1,000 a month raise or a $1,000 a month income increase for whatever reason. Would you be excited about that? And most people, the answer is yes. Most people would kind of celebrate, go out to dinner, whatever, be happy about that situation. Let's say you had some sort of payment that was $1,000 a month, and now you finally paid it off. Therefore, you don't have to make that $1,000 a month payment anymore. Are you excited about that? The answer, again, for most people would be yes. But interestingly, most people are less excited about paying off a bill or debt than they are about an increase in income. And this is a common misconception. It's a financial literacy concept that most people miss. I've shared this on the show. For a couple of years, I taught a college-certified financial literacy course. I'm going to share with you a little tidbit here that I think you'll find very valuable. You should be more excited about the payoff of the $1,000 a month debt than you are the $1,000 a month raise in income or increase in income. Why? Well, first of all, if you increase your income, in most cases, don't you have to pay tax on some of that? The answer is yes. So do you get to keep the entire $1,000 month income increase? No, you have to pay some tax on it. But if you pay off $1,000 a month debt, you have another $1,000 a month in your pocket. Positive cash flow, don't you? And secondly, that's guaranteed. If you had a bill that was $1,000 a month, isn't it guaranteed the next month you'd have to pay the $1,000 until the debt was paid off? Yes, of course. What about the income? Is that guaranteed the next month? Most cases, the answer is no. What if you have a job loss? Business goes under, economic change, health issue, any number of things. Again, tomorrow's not guaranteed in terms of future income, but if you have a debt, it's guaranteed you're going to owe it next month, isn't it? Again, we can apply the same principle to the government. The best thing that they could do is reduce spending because that's a guaranteed positive cash flow scenario. Reduce the spending, you reduce the financial issue, the financial concern going forward. Basic financial responsibility. Now, some people say you're barking up a tree. Well, it starts with education, doesn't it? I can say, gosh, a year ago, I was discussing how property tax I feel is one of the most unfair taxes that exist. Because if you own a property and the government can take it if you don't pay the property tax, do you really own that property or are you renting it from the government? Think about that a minute. I felt like a voice in the wilderness. Today, there's a number of efforts to either reduce or eliminate property taxes, particularly with seniors, for example. And even Governor DeSantis of Florida has come out discussing changes or reductions of property tax. That was unthinkable a year ago. Can we as a country return to some level of financial responsibility and get away from this modern monetary theory that's failed miserably? I know there's been a lot of adherence to it because it was easy and it sounded great. And you just print money because if you owed money, you needed some more, you just print some more. Well, it works for a while. That's short-term thinking, not long-term financial responsible thinking. It's not common sense. Can we get back to that? I believe we can. I believe it's possible. Again, it starts with education. It's why I do the show. It's why I do this to educate people and help them improve their financial situation. Let me apply this to another situation. I dealt with a gentleman this week. He was a younger gentleman who had a car payment of $600 a month. Now, you, I'm sure, can relate to this. At some point, you probably have this, or you have somebody, friend or relative, that might have this similar situation. Could be your kids or grandkids even. I don't know. But think about this. He had a $600 a month car payment. He had about a year left on this, and he's decided to double up on the payment to get rid of it, pay it off, which, generally speaking, is wise. So he's paying $1,200 a month to pay it off in about 6 months. And I made a simple statement to him, and the light bulb went on. I said, you have the option of continuing to do that, and in about 6 months, you're going to pay off the car, which is great. Or what if you put the $1,200 a month into a personal bank policy? Let's say you're earning a 6% dividend, which is tax-free, insured, guaranteed, highly liquid. Then each month you borrow $600 from that. You put in $1,200 a month, as he's doing now. Borrow the $600 a month to pay the car payment. Now, the borrowing rate right now is about 5%, so you're picking up about a 1% positive arbitrage. In other words, you're earning about 1% more on the money than it cost you to access the funds to pay the car payment. Now, it'll take him a year to pay that car off, but what's the difference? He's picking up interest or positive arbitrage on the money that he used to pay the car off. That positive arbitrage, that extra money in his pocket, the difference of the dividend he's earning minus the borrowing cost, means he has more money available, and that's just not this year, but it's every year the rest of his life. That's assuming he never paid the loan off, which you can do. There's no requirement to ever pay it back. By the way, it gets paid off by the death benefit. Any outstanding loan balances you borrow get paid off by the death benefit when you pass away. Let's assume he did that. He would earn interest on that money he used to pay off the car every year the rest of his life. He was a younger gentleman, which meant he had probably 40, 50, 60 years ahead of him. Also ran the numbers. By just doing that, using that payment, the money he was using, applying towards the car payment, meant at age 65, he was going to have $1.8 million at current dividend levels, which are on the low side historically, guaranteed, insured, tax-free, and highly liquid. You see, he took a simple thing like a car payment, reallocated how he's using it, the same money, no, not additional money. He was already paying the $1,200 a month. He reapplied it using the personal bank policy, borrowing against it, getting positive arbitrage, and built up a nest egg of $1.8 million, tax-free and guaranteed and liquid at retirement age. You see, it doesn't take a big amount of money to make a huge difference, particularly if you have time. Obviously, as you're older, if you have less time, the impact is not as significant, but the younger you are, the bigger the difference. And this is money you would have no other way through no other investment because he's got to pay the car off anyway, right? He has a car payment. But why not reapply? And you could apply this to any debt you have, a car payment, house payment, student loan, any other debt, business loan, anything else you matter. You probably know someone. If you're not in that situation, you may be. Contact me at yourpersonalbank.com for more information. I can share with you how to build wealth while paying off debt and create positive arbitrage. If you don't have that situation, you perhaps know someone, again, friend, family member, whatever, that could change their financial life dramatically. I find that exciting. If he applies this, which he intends to do, if he applies this strategy, it's life-changing financially. I have stated this before. Anyone who understands this can be, in America, can become a millionaire plus. And the last thought I'm going to share with this, somebody else will say, well, you could invest it in the stock market or some other asset and build wealth that way too. Granted, you can, but here's the problem. I'm going to tell you this is the problem, particularly with younger people. If you tell them to invest in the stock market, an IRA, 401k, or some other form, and they can't touch the money for 20, 30, 40 years even, many of them are not willing to do that, particularly if they're entrepreneurs or have a desire. What if they want to start a business? What if they want to buy a home? What if they want to have access to the money or they have an emergency? By socking it away and not being able to touch it, it limits their opportunities. And what if they have an emergency? Life is unpredictable. My point is simple. This is why many people fail, because they don't want to commit to that, commit their money for decades, literally, before they can touch it without significant penalties, taxes, whatever. If you're older and you're just wanting to increase the return on your monies with guarantees, ensure you don't lose, protect the downside, well, I can help you there too. Again, it's the golden era of fixed assets. We're seeing annuity returns we haven't seen in over 40 years. We got A-plus rated companies paying 8% guaranteed first year. We haven't seen that in over 40 years. It's a tremendous time. It's an exciting time. I'm able to make a difference in people's lives more significantly than at any point in my 25-plus year career. Couldn't be more exciting. I hope and pray that this Mideast war is settled quickly with minimal loss of life. But in case it doesn't work out that way, and it turns out to extend and get ugly, I strongly recommend protecting yourself, reducing your market risk, getting guaranteed returns, some of the best rates we've seen in over 40 years. If you want more information on that, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for great information, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.